Yeah, good morning, guys. Just give me a minute. Let us have a quick revision of Ind AS 109, that is financial instruments, which is very big standard. So, this is done in two parts. If required, we'll do another half an hour or 1 hour if it is required. Right. Anyhow, my name is Ravi Kanth Miriyala, a chartered accountant from Bangalore. All right. And yes, I'm an author of India's Made Easy Financial Reporting Made Easy and Fast Track book of for CA Final Financial Reporting and so many other books of CA Inter. Yeah, before getting into the subject, yes, my dear, before getting into the subject, let us have a look at, some small information which I need to share. Yeah, we SS Academy are teaching with an academy. All the faculty of SS Academy are on the platform of an academy. Right. Our batches on an academy are 100% English, only English. We teach for CA Foundation, Inter, and CA Final. Yeah, for CA Final, I'll be taking two subjects. One is financial reporting, that is paper one, and the second one is GFRS, Global Financial Reporting Standards, which is elective paper number 6E. Yeah, that is also 100 marks. Yeah, both these courses online, it's already in an academy, it is recorded, which is available for the students. Yeah, recorded lectures, you can watch it. And we have done approximately, um, how many number of hours? Approximately 300 hours discussion has happened, in detailed, in depth, everything is covered. Correct. After these classes, I don't think so you need to refer any other material, not at all required, because every concept is in depth discussion already happened. Okay, right. And with respect to GFRS also, it took approximately 75 hours of class, right? And a full ICI material, your mock test papers and previous examination questions, everything was discussed in the class. That was also excellent, and students do enjoy without doubt. Fine, right. Let's come to this small information, which is CA Iconic program by an academy, which is launched. Correct. This is for CA final also. It is available. Yeah, it is written CA intermediate, but yes, same program is available even for the CA final. Right. In this, what will happen? Live mentoring. Correct. The crucial points in this is mentoring. They will appoint one person for you. Okay, I mean his mentor, he will coordinate everything. Okay, coordinate, I mean, if you have any conceptual questions or doubts or something, yes, he's there to help you. He will link the master, right? You can, end of the day, your doubts will be solved automatically. Next, a doubt solving session. Yes, yeah, if you have any questions, that is what we will handle it separately. At the same time, evaluated test papers. Yeah, evaluated test papers. Yes, I mean, for every subject they will be conducting three examinations, right? You can write the examination, send the paper. Yes, some expert, subject matter expert is going to correct your papers. Okay, yeah, subject matter, just a second. Subject matter expert, yeah, subject matter expert is going to correct your paper, as well as, I mean, they will come back with the, corrected paper. Correct. Now after evaluation, they will sit over call. Yes, and they will guide you how to improve yourself and etc. That's going to be excellent for your thing. And if you take plus course subscription, you will not get printed material, but now with iconic course, you will be getting the printed material, right? An industry expert session. Yes, they will call some industry experts, and their information, their input will be useful for your future career without doubt, right? And in addition to live class, as usual, in the live class, you can, you have an option to speak directly. It's not just only chat. You can raise hand and we say we approve it. At the same time, you can ask your question orally, and we'll understand, and we can respond to you exactly. Okay, right. So like this, so many benefits are there. This is the live mentoring in iconic. Okay, experience personalized learning like never before, and the discussion of your doubts, customized study plan. Yes, they will plan what to do, when to study, when to conduct exam, everything, that all will be in line. Okay, right. At the same time, evaluated test papers, right? As I said, once you have 3 test papers for every subject, once 40% of syllabus is done, one test will be conducted. When it is 80% of syllabus, another test will be conducted. When you are done with 100% of syllabus, one more test paper will be conducted. This is there for CA foundation. This is there for CA, CA final. Yeah, it is for CA final. Group 1 separately, this option is available. Group 2 separately, this option is available. Group 1 plus group 2, that is combination, also this option is available. When you are, use the code YESHAS live, LIVE live, YESHAS live. If you use the code, you will get 10% discount. 10% discount will be available for that. Okay, yes my dear. So that is about the announcement. Let us look at where is the, yep, yeah, yes my dear. So let's focus on the today's matter, which is in Ind AS 109, Ind AS 32 and Ind AS 107. See, all the three standards talk about, all the three standards will talk about financial instrument. Yeah, generally in one standard, generally, other than this standard, if you see any other standard, Ind AS 2 you take, Ind AS 7 you take, Ind AS 16 you take, whichever the standard you want, you take it. Yeah, generally objective, right, scope, definitions, recognition, measurement, presentation, disclosure. These 5 points are going to be a part and parcel of one standard. But maybe because of the voluminous of the standard, correct na? If you take a printout of the bare standard, it will come to approximately 400 pages of all these three standards together, including the guidance given by them. Understand? 400 pages plus it will come, not less than that. So then you understand, correct? Now, they don't want to make entire subject into one standard. They have divided it into 3 parts. Yeah, Ind AS 109 talks about recognition and measurement. It talks about 32 talks about presentation, only for presentation. Presentation means whether shall I present it as equity or liability, or do I need to bifurcate the equity and liability? That is discussed. The classification, especially classification, presentation, is discussed by Ind AS 32. And when it comes to 107, Ind AS 107 talks about, Ind AS 107 talks about what is that? Ind AS 107 will be talking about the disclosure part. Fine. These put together, these 3 standards are going to be your financial instrument one topic. Got it? Right. 107 we don't need to discuss. That is disclosures. For examination point of view, yes, it is not necessary. Yes, but practically, obviously, you need to be aware of what to be disclosed, what not to be disclosed. Correct? Na? What is a basic requirement as per the standard? You need to be aware of it, but for a practical purpose. But for this examination purpose, 109, 32, be thorough. That would be more than sufficient. Okay, my dear. Yes, chalo. What is a financial instrument? Yes, I told you we have totally 2.5 hours. Right now, 1 hour 15 minutes, half an hour break. Again, one more session, part 2 will start. That is also 1 hour 15 minutes. Right, we will be covering almost. That's what I'll try. Okay, if required, another half an hour or 45 minutes. Also, one more part 3. If it is required, then I'll take it up. That's not an issue. Let's give 100% clarity. Okay, full picture. Let me try. Okay, right. So what is a financial instrument? Financial instrument is a contract. Yeah, when I say contract, there should be contractual, enforceability should be there, right? It is a contract. That means 2 parties must be there. Yeah, which gives rise to a financial asset in the books of financial asset to one party, financial liability or equity to another party. Yeah, there are contract means 2 parties are there. Agree? Right. So for one party, yeah, understood my point. For one party, it is going to be a financial asset. For another party, it should be either financial liability or equity. What is financial asset? What is financial liability? What is equity? All these 3 new words also correct. We are supposed to have a look at it. Yes, I told you it's a contract, means there must be an agreement. Yes, my dear, there must be an agreement. Yes, there must be an agreement. Yep. Right, enforceable. Yes, an agreement, it is enforceable by law. Correct, it must be either oral or written. Correct. No, we have many financial contracts, that is either sale of goods. Yes, I sold goods, right? I got debtor. It is a financial asset. Another party has to create a financial liability, isn't it? Yeah, because it is he has to pay me. When I say debtor, the other person has to record as a creditor. Correct. I purchase Reliance company equity share. It is a financial asset to me. For the Reliance company, it is a equity. Correct. So it is giving rise to, it is a contract between me and the other party. In my books, it is a financial asset. From other point of books, other party books, it could be either financial liability or it could be an equity. Okay, right. Let's try to understand the big definition. What is financial asset and what is financial liability? Yeah, whatever you are watching, that is from my book Fast Track. Correct. Quick revision, fast track charts on financial reporting. Okay, quick revision on fast track. Yeah, this book is available in the market. Yes, you can order it online and you can buy it. Yeah. So first, what is a financial asset? Financial asset is cash. Cash is financial asset. That's all. Next, investment in equity instruments. See that he has not told investment in equity share capital. Equity instrument. Got my point? Yeah, it is equity instrument, means it should, the instrument which has the equity qualities is equity instrument. That's all. What is equity, which we are going to discuss in few minutes, right? And there is a contractual right. Yes, there is a contractual right to receive either cash or any other financial asset, or there is a contractual right to exchange. There is a contractual right to exchange financial asset or financial liability, yeah, which is potentially favorable to me. Correct. Now, which is potentially favorable to me is a financial asset, which is potentially unfavorable. Correct. Now, look at this. Exchange a financial asset which is under potentially unfavorable conditions. Yeah, which is potentially unfavorable to other party is a financial liability. What is a financial asset to me? It is a financial liability to the other party. Got it? Right. So in case of call option, yeah, if it is in the money, yes, I am a holder of call option, or I am a holder to a forward contract. I am a holder, I am a buyer. Otherwise, I am a party to a future contract. Yeah, if it is in the money to me, that means it is an asset to me. At the same time, when it is in the money means for the other party, it is out of the money for him, then obviously he is liable to pay. I have an asset, financial asset, means automatically it is going to create a financial liability. Correct. Automatically it's going to create a financial liability by the other party. Got my point? Right. So for holder it is receivable financial asset. For the writer, if it is an option means, holder, writer, two parties. Yes, receivable financial asset. For the other part, it is a financial liability. Yeah, these points are there. These points you can ignore it. Okay, you can ignore these points. The reason, these are all purchasing our own shares. At least in India, it is not applicable. Correct, na? Wherein it is a contract wherein we are going to buy our own equity shares or our own options or something like that. No, it is not going to be applicable. Correct, na? If you buy our own shares in India, it is called buyback. Correct, na? There is legal applicability, procedures, and etc. is there, and I cannot hold my own shares. Obviously, agree my point. So that's the reason. Hope you understand. It is not applicable to India at least. Okay, let's go to, that's all. So there are totally 3 points. One is cash, contractual, right? Contract, correct. Our next second point is investment in equity correct. Now, investment in equity instruments of another company, right? Contractual rights to get cash or any other financial asset. Next, contractual right to exchange financial asset or financial liability under potentially favorable conditions. Yeah, come to the next point. Contractual obligation. Yeah, it is a contractual obligation. Yes, it is an obligation to deliver cash. Yeah, we have an obligation. Got my point? We have an obligation to deliver the cash, right? That means our duty. Yeah, I purchased goods from somebody, it's a creditor, then I'm supposed to pay money. Correct, na? Money or some of my financial, I will write a bills receivable to them. Correct. Now somehow I have an obligation to settle it. Then it is a financial liability. Right. And next, a contract that, yeah, this is crucial point. Generally students get confused, or students, I don't correct now, sometimes they feel difficulty. Yeah, what is that? A contract that will or may be, yeah, it not necessarily it has to be, that will or may be settled in own equity instruments. Yeah, means how are you going to settle this liability? We will give our own equity shares, sir, and we will close it, sir. Okay, excellent. Yeah, that means we are going to issue our own equity shares. Fine. How it is happening? Yeah, it is a non-derivative, correct, which is deliverable in variable number of equity shares. In simple, remember, we are going to give variable number of equity instruments. Yeah, for me, I mean, in nutshell, instead of making it, okay, right, instead of making reading this so much information, I can make it in simple words. What do I say? Rebus, correct. Now, what is the amount you are supposed to pay? Got my point? Correct. And what are the number of shares? Correct. Now, what is the number of shares you are going to get it? Sir, I am going to get. What is that? We are going to get, and what we are going to give. What you are going to give. Right. First question. If you say, yeah, blind remove. Just remember this, a blind rule. Okay. If you say you are going to get an amount, is it a fixed amount? Yes, sir. It is a fixed amount. Right. Are you going to give how many number of shares? Do you know very clearly? Yes, sir, I know very fixed number only I will give, because I already spoken this. You give me 1 lakh, I will give you 1000 shares. 1 lakh is fixed amount. It will not vary. Correct. Now, later on in the future, he will give 1 lakh. I have to give him 1000 shares. Then I say it is not financial liability. It is an equity. Equity in the sense what? Yeah, it is equity because it is like an advance given for equity share capital. Agree? Yes, it is obviously advance given for equity share capital. It is not financial liability. Okay, right. In any other combination, it is a financial liability. What is that? How much amount are you going to give? That will be variable, sir. How much I will give means it depends on the fair market value. It depends on something or other contingency. Okay. How many number of shares are you going to give? This also I don't know, sir. Will depend, sir. How is it? Then it is a financial liability. Correct. It is variable, sir. It is fixed, sir. Yes, this is also financial liability. Sir, this is variable, sir. This is fixed, sir. Yes, this is also financial liability. It's like that. Okay. Only in the combination of fixed comes. Means fixed amount is receivable. Fixed number of shares are supposed to be issued. Fixed number of shares are supposed to be received. Under that circumstance alone, it is going to be treated as equity, and all other combinations, in all other combinations, it is going to be, what is it going to be? Financial liability. Is that clear? Right. Chalo. Next point. What about the, right, some examples. Loan settlement by issue of shares based on the market price. See, loan settlement issued, loan settlement. I am going to settle my loan. Fine. How many shares are you going to give? Sir, loan amount I know. Loan amount is equal to 1 lakh, sir. Divided by, based on the market value. Today market value is how much? Correct. Now, today market value. I mean today, this is not today. We'll settle on so and so day. If I say in the future, not as on 31st March, it will be settled by using the market value. Right. In the future, I will be paying. What is the market value? Whatever X. I don't know exactly what is the number. Yeah, if what is the fair market value? If you keep 100, some number of shares will come. If you keep 110, another number of shares will come. Correct. Now, so number of shares what you are giving, is it fixed? No, it is obviously variable. So any one item variable is there, without doubt it is a financial liability. That's all. Okay. As part of the restructuring loan, lump sum payment you are supposed to pay. Okay. Lump sum payment to settle. Payable any excess amount. Yes, that is, I mean, you are going to pay little more money than what is there. Yes, I mean, you are closing the old liability and you are getting a new liability. You are exchanging financial liability with another financial liability, wherein you are only losing little more money. That is, it is a right, it is an obligation to exchange a financial liability with another financial liability, which is potentially unfavorable to me. Yes, it is also financial liability. Got it? Right. We bought a call option. Yes, exercise price is equal to 100. Yeah, I can correct now. Market value is equal to 120. Yeah, market value is equal to 120. We have a call option. Market rate is 120. I can buy it at 100. That means, isn't it in the money? Yes, that means R20 is a financial asset to me, and the writer of the option, it is a financial liability to him. I will record financial asset account debit to income, profit and loss, and the other party will record loss account debit to financial liability. He will record it. Okay, right. Same as 3. For the writer point of view, it is a financial liability because it is potentially unfavorable to him. Got it? Hope you understood. Right. Next, equity instrument. Equity instruments, we can define it in two ways. One, what we say, residuary interest in net assets. Okay, my interest is, I am interested, means I will get what I will get. I will get net assets in the company. Net assets in the sense assets minus liability. At the end, at the time of liquidation, at the end, to whom I should pay. Okay, they don't have right to ask me, but I will pay the net assets to him. That is only, this is the direct definition I can call residuary interest in assets after deducting the liabilities. That is one way of defining. Right. What about the indirect method of defining? Yeah, we can say which is not a financial liability is also equity. Obviously, correct. Na? Yeah, what is financial liability? We spoke. What is not liability is nothing but equity. Suppose I got money, excellent. I don't have an obligation. Nobody can ask me, refund of the same money. That means it is my equity amount. Obviously, correct. Na? Any amount where I got money and I don't have an obligation, nobody has a right to come and ask me, "Hey Ravi, pay me back." When nobody has a right to ask me, automatically, correct? Na? Automatically, it is my money. I can transfer this to, I hope you understand. I will transfer it to equity. That's all, which is not financial liability. Same matter, once again, it is explained. Since we have learned just now what is financial liability, we don't need to bother about it. Okay, right. Now, generally the questions, students will be asking, so preference share capital, is it a liability or is it equity? Got my point? Is it a liability or is it equity? Yes, look at it. Yeah, see, whenever preference share capital is there, you have to think about the two things actually. What are the two things, sir? Yeah, one is principal part, then the next one is equal to dividend part. One is principal part and the next one is equal to dividend part. All right, both of them you are supposed to analyze it together. Okay, you have to analyze it separately. You are supposed to analyze it and then you come to a conclusion. Yeah, sometime it may happen. Principal may be equity element and dividend may be a liability element. Yeah, so within one instrument, when both elements are included, then we call it as compound financial instrument. What do we call compound financial instrument? Means within one instrument there is an equity component as well as liability component. When both are included in it, then we call it as compound financial instrument, because it is not 100%. It doesn't have only one quality, it has both. Then what should I do? Standard 32 told us very clearly, we are supposed to bifurcate it and account separately. Equity should go to equity, liability should be liability. We have to bifurcate. How to bifurcate? That is what we'll revise it once. Fine. Yeah, the question is principal, sir. Yeah, when one question, basic question, as per the terms, and first of all, you are not supposed to analyze it by looking at the name of it. Yeah, you are not supposed to analyze it based on the name of it. Understood? Right. You have to look at the terms and conditions. You have to look at the terms and conditions of the agreement. Yes, you have to look at the terms and conditions of the agreement, not by the name. Going by name is very dangerous actually. So principal, when I say it is redeemable, what did I say? It is redeemable. Redeemable means I have an obligation to repay. Yes, perfect. When you have an obligation to repay, correct? If the company has an obligation, fine, it is a financial liability. Yeah, one more step we went. Correct. Is it at the option? Suppose it is redeemable at the option. At the option of the holder. Yes, if it's at the option of the holder means holder has right. Any day they can come and ask me, hey Ravi, you pay me my money. Yes, I am supposed to pay. I have to oblige. Correct. I have to accept their request. That's why we say it is a financial liability. Okay. Sir, no, sir. It is in the hands of the issuer, sir. Means entity whenever they feel they can redeem it, correct na? An entity whenever they feel they can redeem it, that's up to me in the sense, yes, it is not, I mean, it means what? Other party does not have right to ask me, other party does not have right to ask me. That's why I will say it is equity till the date they decide. Who will decide? The company decides. Array, let us will in the board of directors we take a call. What is that? Let us redeem this money. Like that they have decided. Once they decide, then bring it from where? Equity account debit to liability, because we have exercised the option. That means you are liable, we are liable to pay them. Got my point? Next, irredeemable. Irredeemable means will not repay, sir. Will not repay. Or will not repay in the sense, it is not that we never repay in life. We'll repay them at the time of liquidation. Obviously, at the time of liquidation. Right. So, but under that circumstance, you have to look at the dividend terms also ek bar dekhna, because it may be equity from the principal angle, but it may be a liability from the dividend angle. That's why you have to have a look at dividend terms as well. Next, if the dividend at the option of the issuer, see this, if the dividend is payable at the option of the issuer, company decides whether to give dividend, not to give dividend. Then principal also I am not responsible, dividend also nobody has right to ask me, then obviously it is equity to me, it is 100% equity instrument to me, right? Next, come to the dividend angle. If you see, okay, dividend, it is at the discretion of, okay, at the discretion of the issuer. Yeah, I mean, company will pay whenever they feel. If they want, they will pay. Otherwise, they don't want to pay. Under that circumstance, I'll classify it as equity. No, sir, it is cumulative and payable. Correct. It is cumulative, sir. It is payable on liquidation. You understood? It is payable on liquidation. Means we can start postponing. We will pay liquidation. Liquidation, so as of today, whether the shareholder has right. Right. I have the right. I will pay only at the time of liquidation. I can accumulate it and I'll pay. Under that circumstance, seriously, it is equity. Okay. Right. No, sir, we have an obligation to pay dividend. It's like cumulative. You have to pay every year. That means it is a liability. We have to accrue it. That is about correct. That's what I see. You have to look at the terms and conditions. You have to look at with what is our obligations or duties with respect to the principal amount, and what are our duties with respect to the dividend amount. You have to have a look at it. Accordingly, you should come to a conclusion. You can't decide it so fast unless until read, understand. Otherwise, correct the terms and conditions, because I have seen some agreements with respect to different companies. Correct, some words will be missing, confusion will be there. Correct na? Then you can't decide, you can't take a call so easily. You have to analyze it, then you should take a call accordingly. Okay, my dear. Yeah. Is there any contract? Yes, question. Sir, if no, sir, there is no contract. Yeah. Say example, legal obligation. Yes, legal obligation. What is legal obligation? I will say tax payment. Correct na? There is a tax payment. Tax payment, there is no contract between me and income tax department, but I will pay. Why? Because it is as per the law. That's all. But when I say it is not a legal obligation, I mean it is not, there is no contract. When there is no contract, then it is not a financial instrument. Don't need to be in this standard at all. You should just come out of this standard. Next. Yes, sir. Yeah. Obliged to deliver. Right. Is there a contract? Yes. Are you supposed to pay something? Yes, sir. We have to give either cash or other financial asset. Then it is a financial liability. Right. No, sir, I don't have an obligation. So are you supposed to exchange anything? Yes, we have to exchange. Now we'll ask, is it potentially favorable or unfavorable to you? Sir, potentially unfavorable to me. Yes. Then it is a financial liability. Sir, it is potentially Correct. It is not potentially unfavorable also. Next, are you supposed to give your own equity instruments? Yeah, for a variable amount of, correct. Are you going to give variable number of shares and for variable amount of money? Any one of these? If you say yes, then it is financial liability. Then otherwise, if you say no, then it is equity. Means I got money. I don't need to give any cash or financial asset. I don't need to exchange, and I don't need, correct. I'm not going to lose anything, and I'm not going to give financial equity instrument for fixed amount and fixed, consider fixed amount and fixed number of shares I am going to issue. Then obviously it is equity. I am not liable. I just got money. I don't have any kind of obligation. It is financial. It is equity, but not financial liability. Got it? Next. Yeah. So that's why, what do you say? There's share warrant example. Yeah, share warrant in the sense amount is very clearly fixed. Number of shares are also, what is number, how many number of shares we are going to give, that is also fixed. Then it is equity. It is not a financial liability. Correct na? It is equity. It is not a financial liability. Next, look at 12% 12% compulsorily convertible debentures. Sorry, preference share capital. Yeah, and which will be turned into fixed number of shares after 5 years. Yeah, it is compulsory, pakka. It is not option of anybody. We are going to turn it. Perfect. Dividend is at the discretion of the company. See, with respect to dividend also, I am not responsible. If I may pay, but holder does not has right to ask. I am a good person, I will pay. Understand? But holder does not have right to ask. Then it is purely equity. That's all. There is no obligation to deliver cash, not variable number of things. So purely equity. Even share warrant also same as above, equity only. Right. Suppose lack of access to foreign currency and approval of regulatory authority. Correct. See, the point is whether you have lack of foreign currency, money will come, I will pay. It's not that. What is said in the terms? Are we liable to pay? Then it is liability. That's all. Right. No, no, sir, we don't need to pay. Then it is equity. Like that, we are supposed to analyze it. Not based on lack, correct. Currently, I will not be able to pay because my currency is not convertible. Such kind of things are useless. Just forget about it. Yeah, this table only I have explained you. Fixed equity in all other combination, correct na? Fixed variable equity in all other combination, it is going to be financial liability. Next, contract to buy a non-financial asset. What is this? Right, we decided to buy. Yeah, yes, so we entered into an agreement to buy what, sir? We decided to agreement buy copper. Okay, excellent, you buy. Now the question what you will ask, how do you settle it? Copper, correct. Do you take the gross settlement of it? Means I will take copper, physical delivery of copper, I will take it, sir. Yes, sir. Then sorry, sir. It is actual exchange, correct? Na? Then it is scoped out. Why? What you give, I will give cash. What you get, I will get copper. Copper is a financial asset? No, sir. It is inventory kind, maybe, correct? Na? Right. It is non-financial asset. Yeah, non-financial asset. What are you exchanging? Financial asset with non-financial. Sorry, it is not within the scope of it. Financial asset with financial asset then comes into the picture. Otherwise, it will not come into the picture. Got my point? Right. Sir, sorry, net settlement I am doing. Net settlement in the sense, right, no delivery of, correct now. We don't deliver. We don't take the delivery of copper. What do? Just look at the copper value today. Yeah. Say, we promised you to buy. Buy at what amount? Buy at 100. Okay. Today, what is the today market value? Today market value is equal to 120, sir. Today market value is equal to 85. What is that I said? Today market value is equal to, right now, 120 or 85. Yeah, if it is 125, I said I'll buy at 100. Market value is equal to 120. Then what do I get? I get 20 rupees net settlement. 20 rupees cash will come. What do I get? Cash. Isn't it a contractual right to receive 20 rupees of cash? Yes. Then it is a financial asset to me. Agree? Right. No, sir. I told them I promised them I'll buy it 100. But today market value is equal to 85. So do you take the delivery now? No. Today also I don't take delivery. Under net settlement, what do? I will pay 15 rupees. I will pay. Getting my point? I will pay 15 rupees and I'll close it. That means, do you have an obligation to pay? Yes, surely I have an obligation. Then I will say it is a financial liability. It is a financial liability. Got my point? Right. Next important definition, which is a derivative contract. Yeah, derivative contract. I hope you are able to catch so far. Right. Chalo. Let us proceed with. Right. First, a derivative. When do you say an instrument is a derivative instrument? They have given three definitions. One definition, three conditions are given. Okay. If you satisfy all the three conditions, then I say it is a derivative instrument. Otherwise, sorry, it is not a derivative instrument. Okay. Right. So when do you call it as derivative? When you satisfy all the three conditions, then I call it as a derivative instrument. Got it? Right. Value changes. Yeah, first one. The value of the contract goes ups and down. Okay. Value of the contract goes ups and down based on what? Based on some underlying asset or index or price, something, some rate. It could be based on, it may be a share price, based on, it may be a debenture price, based on interest rate, based on foreign currency. It could be anything. Okay, based on Sensex. Yeah, the value of the contract must be fluctuating. That is first and foremost condition. Next, yeah, which may require a little investment, okay, or it which may require what is that, no investment. Yeah, if you remember in case of forward contract, if you remember in case of forward contract, there will not be there will not be any investment, correct? And if in case of option, do you need to pay some money? Yes, we have to pay money. That is called premium, we call, correct na? But the premium is obviously lower than what you suppose. If you buy a shares, correct na? A lot of 1,000 shares, sir, 1,000 shares, if you buy, it will cost me 10 lakh. Okay, but a premium amount is equal to how much? 1 lakh. That means it is hardly 10% of the total contract value, correct? It is little only, I will call it. Got my point? Right. Sir, in case of future contract, yes, in case of future contract, what are you supposed to give? Sir, I have to keep a margin, correct now? I have to keep margin money. You have to keep margin money. When I say I have to keep margin money, yes, this is also little investment you are supposed to keep. Again, my dear, e margin money what you have kept, correct? What you have kept is only to ensure the safety of settlement. Other than that, nothing, correct? It is only to settle the safety. Fine, right? This is also little investment we will call. Not, this is for the fluctuation difference amount. That's all. It is not for the entire share value. Agree? Right. So that is what options, future, forwards, swaps. These are all derivative instruments. Right. There is one more concept of putable financial instrument. Putable instrument. Yeah. This example which I give you always is mutual fund units. Okay, na? Yeah, I will give mutual fund units as example. Mutual fund units. See, mutual fund company, you will buy units of the mutual fund company. Correct, na? Yes, sir. I'll buy. Right. Isn't it correct? Na? Is it mutual fund units for the mutual fund entity? Is it equity? First basic question. Is it equity? Equity, so based on so far understood definition, what do I say? No, sir, it is not equity. Why is not equity, sir? Because I am a unit holder. Whenever I want to redeem the money, I can give it back my debentures. Sorry, I can give back my units. Then other party has to pay me back. I mean, a mutual fund company has to pay me or not? Yes, it has to pay. That's why, correctly speaking, it is a financial liability. Correctly speaking, it is a financial liability. But I mean, if you say units are only financial liability, that means it is like mutual fund mein there is equity is equal to how much, sir? Equity is equal to 0, sir. It will be odd, correct? Now that's why they have brought a new concept called putable financial instrument. Yes, units are put means what? Put means put to sell. Correct? Na? Put means put to sell. When I say, I mean the unit holder, what am I trying to tell? He has a right to put whenever he doesn't want it, he can put back. Put back in the sense I can give back to the mutual fund entity. I can get my money. Are you getting my point? Correct. So that is called a putable instrument, we say. Yes, but the putable instruments, right, subject to some criteria. They have given actually 6 conditions are given. If you satisfy the 6 conditions, then I say, even though these are all strictly speaking, it is a financial liability, still we will be qualifying, still will be classifying them as equity instrument. Still, I will be able to classify them as what is that? Equity instrument. I told you subject to 6 conditions. These are all the 6 conditions which I have given here. Yeah, what is that, sir? Yes, holder entitled for pro rata of net assets. I am a unit holder. I will be getting pro rata. That is NAV, you know. NAV means net assets value, obviously. Correct na? Whenever today I want to come back. I mean, I am redeeming my units. Then what is the today value? A value I am supposed to get. Net asset, today net assets is how much? Money. I will get my share in that. Yes. With respect to mutual fund, first condition satisfies. Done. Second, we are subordinate to all the class of other instrument. Subordinate in the sense least value, least not in the value wise. I am going to get money after paying to all the people. That's all. I'm the last one. I'm the last one in the queue. Yeah, mutual fund units are the last one. You understand my point? The next point, what is that? Suppose, sir, after me also one more person is waiting, sir. After you give money, na, then only you will give it to that money. That means he is subordinate to me. Means correct na? Units should be the last person. Then it is equity. First units holder will get the money, sir. Afterwards, one more person is there. That person is going to get. Then I say that person is what? Equity. I am financial liability to the entity. I should be the one who will get towards the end. After me, nobody should be left. Then it is exactly equity qualities. You have units, name is units, maybe put option is there, but still you have in substance equity option. Correct? Equity qualities are there. That's why units are going to be called as equity, but not financial liability. Next, all other classes have identical features. Yeah, other classes are same features are there, no problem. But I should be subordinate to all. I should be subordinate means what I get should be the last amount. Then it's fine. No other contractual obligations other than redemption. Correct. I mean, company does not have any other obligations other than whenever you put, they have to pay. No other obligation the company has, like dividend you have to pay mandatorily every year, interest you have to pay mandatorily every year. Such kind of things are not there. Okay. Next, expected cash flows are based on the profit or loss during the period. Correct na? What do I give? What we earn, that much only I'll give. But correct na? There is no such condition. Whether you earn, you do not earn. Whether you die or you live, doesn't matter. Pay me every year my money. Then it is a liability to the entity. Correct na? Right. It is not residuary interest. That's what. That means what they say, the expected cash flows are based on the profits or loss. If you got profit, there is a share in it. We made losses, then there is a share in it. That's all. Under that circumstance, putable instrument is going to be equity. Otherwise, it is a financial liability. Next, no other financial instrument exists in the company like this. Correct na? Like this means I told you na, this point is sufficient. Actually, is subordinate to all instrument is sufficient. Yeah, see, end of the day, with all the 6 points, they are trying to ensure that we have equity qualities. Yeah, what are they trying to ensure? The putable instrument accept the only option for put. Okay, other than that, all other qualities are exactly equal to equity instrument qualities are there. That is the reason. Okay, right. See this examples I have given. Maybe it may be helpful to you. There are 2 classes of putable shares. Okay, how many classes? 2 classes are there. Fine. Entity A is a pro rata entitlement, correct? Entity B pro rata entitlement but limited to 10 lakh rupees. That means you are not getting pro rata basis, pro rata to the net assets of the company. Your limitation is maximum 10 lakh. That means it is a financial liability. And the first one is obviously pro rata to the net assets. Yes, it is a equity. You have entitled for that. The company has ordinary shares and putable shares. Both are there. Then obviously, my dear, putable shares are liability we will call. Ordinary shares means equity shares are also there in the company. Na? That will be equity share capital. The ordinary share capital will be equity. The putable shares will be financial liability. Okay, that means putable shares, no right to vote but equal rights on the net assets. Sorry, still you cannot be called as equity. I told you, you should be the last person. There should not be any subordinate to you. You should be subordinate to everybody. Means you are the last person. But here already ordinary shares are also there, no? Then ordinary shares will be called as equity, and e-putable instruments cannot be called as equity. That should be called as a liability. Next, putable convertible shares. Yeah, but convertible into variable number of equity. It's going to be converted into equity shares. First reason, we will convert you into equity means there is one more class. Correct now? Who is eligible for net assets really? Agreed. That means you are not the subordinate, right? Next, that from there itself you can make out it is not equity. It is going to be treated as financial liability, which the equity shareholders what are already there. No, that is what really equity. E-putable instruments will be called as liability, not going to be classified under, not going to be classified under, hope you understand, not going to be classified under equity. Done. Reclassification of putable, these are all basic things, my dear, just run through, that would be more than sufficient. Yes, let us get into the next small topic, that is compound financial instrument. What is that? Compound financial instrument. Right. As just now I told you, compound instrument means what is that? There is an equity element as well as liability element. Yeah, it is compounded. It is a hybrid contract. Correct? Hybrid. It is not one. There are two qualities are included in within this. There are two qualities are included within this. That's why what are we supposed to do? Initially, first time when you become a party to the contract, that time itself, what are we supposed to do? Bifurcate it. Equity should be equity, liability should be liability. Okay, once instrument has a partly financial liability, that is what this. Separate the item at initial recognition and account it. Yes, separate and account it. Liability is liability only, equity is equal to equity. You cannot continue both things in under one category. No, it is not both things under one category. Right? Yes, examples. The debentures redeemable after 10 years. But dividend is payable at the discretion of the issuer. Very good. That means interest is my discretion, so there is no obligation. Correct na? Principal I have to repay after 10 years, which I am obliged to do it. It is obligated. It is an obligation for me. Then it is compound finance. Correct na? Principal amount is a liability. Dividend amount by option, so it is equity. Done. Next, loans are perpetual, but we have to pay interest every year. Loan is perpetual. When you say perpetual means only at the time of liquidation only will redeem at the time of liquidation. Then e principal, when I say principal, correct na, e principal is equal to equity. Yes, and what about the interest? Every year I am supposed to pay interest. It is a financial liability. It is a compound financial instrument because it has both the qualities. Right? Convertible preference shares at the option of the holder. The option of the holder in 10 years. Otherwise, we have to pay 10 lakh. I mean, you have to pay at the end of the Y10. Yes, we have an obligation. Yeah, when X is correct. Now, 1 second, guys. Sorry. Yeah, sorry. Um, what do you say? Convertible preference shares at the option of the holder. Yeah, at the option of the holder. That means we have an obligation when correct now, because it is option of the holder means isn't it liability, my dear? Just now we spoke na. Right. Means anytime that guy can come and ask me. Yes, yes, he can come and ask me. So I should say it is a liability. Correct. Now holder has a right. Means I have an obligation. At the end of the 10th year, he can come back and say, hey, Ravi, redeem. I want cash. Fine. Okay, Guru, I will pay you. That's all. I don't have an option to skip. I don't have an option to postpone. I don't have anything. That means I am supposed to pay them whatever they decide. Correct. That's why it is a financial liability. But haven't we given an option? Yes. Yeah, convertible option. Yes. A convertible option is what called as call option. Okay, it is call option. When I say it is a call option, yeah, we the company is what? Company is a writer of the option. Yeah, company is a writer of the option, and the holder is equal to the holder of the instrument. Correct. So company being a writer, company will be isn't it company getting a premium for that? Yes. The premium is, as you know, you have studied it in SFM. Premium is non-refundable amount. Agree? Yes, it is non-refundable amount. Non-refundable means I don't need to pay back anything, only to the extent of premium. Only to the extent of premium. Got my point? It is equity element. It is equity element. So isn't it compound? Yes. With respect to the principal and interest and etc., it is a financial liability. Very much. With respect to only premium, it is equity. Right. Here what do we call? Yeah, simple thing. Yeah, here what is the host contract? We use the word host contract. Host contract is equal to preference share capital, or it can be a debenture instrument. Correct. And there is a derivative in it. Correct. Now there is a derivative in it. That's why when you have a preference share capital plus derivative, yeah, it is nothing but compound financial instrument. And one more name we use it, embedded derivatives. Embedded derivative. Yes, the derivative is embedded in the host contract. Yeah, derivative is embedded, it is included, it has become part and parcel of the host contract. Got my point? Right. If it is optionally convertible debentures or preference share capital, yes. If it is at the option of the holder, yes, correct na, then obviously equity. Yes, optionally convertible debenture. Yeah, a liability is nothing but the host contract. Yes. And what is that we have given? Just example, host contract can be debt instrument, service contract, it may be equity, it may be lease, it may be insurance contract, it can be anything actually. I can enter into a contract. I will say, Array, you Mr. X, you have to pay me rent. Okay sir, I will pay rent sir. How much I should pay sir? I will say, see yaar, 10,000 rupees per month you should pay me. Okay sir, this is for the first year. Excellent. Second year, how much are you supposed to pay? See, Reliance company today share value, today share value is equal to 2,500, man. Yes sir. Why Reliance company share suddenly came sir now? Yeah, there is some reason. Yeah, listen. Okay, right. Reliance company share is equal to 2,500 at the end of the first year. I mean, correct. At the end of the second year. Correct. What is the value? 2,500. Suppose it became 3,000. Okay, that means 500 up. 500 up in the sense, what is up? Up is equal to 20% up. Correct. Na? 20%. Yeah, previous year rent 10,000 plus 20% you have to pay me. Got my point? I'm linking. What am I linking? Right. I am linking the share. Correct. I am linking the returns of the. I'm linking the Reliance company share value. You understood my point? Reliance company share value. I am linking it up with your rental amount. See, where is the link between Reliance company and what is my house rent I am giving it to you? No link. But isn't it a derivative instrument? Correct. Am I not getting the returns of Reliance company in the form of rent? Two things we are linking. That's it. This is also a derivative instrument. A lease contract also. That is what is the lease contract actually. A lease contract also like that they can keep in anything. Understand? That's it. Fine. Yeah. Now what are we supposed to do, sir? I said we have to split and account it. Equity ne, liability ne. Correct na? You have to separate it, you have to bifurcate it, and you are supposed to account for the same thing. Okay, how do you bifurcate it, sir? Very simple. What have you received total? Total proceeds, how much you received? Some XX I got it, sir. Okay, excellent. Right, minus, right? See, I will cut equity, sir, then balance is equal to liability, sir. No, E route is not accepted. We have only one route, that is present value of liability you are supposed to cut. As per the contract, what are your payables? Contractual cash outflows. What did I say? Contractual cash outflow. How much are we supposed to pay? Yes, present value. Yeah, whenever I say present value, correct. Now, present value means what? Present means today, value means where? Value in the market. If you want to know present value, then you are supposed to use market rate of interest. You have to use the market rate of interest. Understand? Yeah, first you decide y1, y2, y3 as per the contract. How much should I pay? Yes, some x number you keep it. This number using the market rate, discount it, you will get some number, number a present value. After that what comes is what? Equity. After that what comes is what? Equity, my dear. Yes, E amount. Like this. Yes, you record cash what you have received, so cash account debit. To financial liability name you write, to equity or other equity you can use the terminology is not a big issue actually speaking. Hope you have followed. Just a sec. Okay, now next. So equity is equal to, yeah, the whole amount of money minus present value of liability. That's how equity you have to derive. Yeah, once equity is separated, correct, once equity you separate it. Yeah, do you remember in the class also we have discussed a number of times, once you bifurcate the equity amount, my dear, no adjustment to equity further. Yeah, equity amount will not go up, it will not go down. No ups and downs. Equity is equal to equity. That's it. Next. But what about the financial liability, sir? Yes, what about the financial liability? Financial liability will be following amortized cost method. Correct, na? Amortized cost method. Yes, you have discounted using the market rate, haven't you? Correct, na? Haven't you discounted using the market rate? Yes. Yes, unwind it using the same rate. Yeah, unwind it using the same rate. That's it. Next. So that's what? Cash account debit to debenture to equity component. We have recognized it. Right. Consider deferred tax effect also. Consider deferred tax effect also. This level they will not ask in the examination. But yes, yeah, you have got a premium. Correct, na? You have got option premium you have received. Isn't it? You have received option premium. Yeah, this is one angle. Yes, you have received 100 rupees of option premium you got. Aren't you liable to pay tax for that? Yes, department will consider as a tax only, but they don't take it right now. Fine. So that's why you will create deferred tax liability. You will create deferred tax liability on it. You will create deferred tax liability on it, and it will be reduced from the other equity itself. Okay, we will recognize other equity account debit to deferred tax liability, like one journal entry 30 rupees, 100 into 30 percentage, we will be recognizing it. Done. There is one more small concept, this is very basic, which you must have studied it in CA Inter. Okay, what is that? Present value of perpetual cash flows without any growth. Yeah, without growth. Then cash flows per annum divided by opportunity rate. Opportunity rate means market rate. That's all. Present value of perpetual cash flows with growth. Present value of perpetual cash flows with growth. That is equal to Y1 cash flows divided by opportunity rate minus growth. Yeah, these formulas are basic formulas which are relevant even at CA final and throughout your life. Remember it because it may be helpful without a doubt. Got it? Yes. um is it mandatory to, right, so if it is mandatorily convertible preference shares, they have asked one question in the recent past. Okay, right, mandatorily convertible debentures, mandatorily convertible preference shares, they have asked a question on that. Then what are we supposed to do? Yes, mandatorily convertible means you have obligation only to pay interest for some number of, correct, I don't have obligation to pay principal. They cannot come and ask me for the principal repayment, but they may come and ask me interest amount till I convert it. Possible. That's the reason. What is the amount? Your interest will be there, interest for year 1, year 2, year 3. Take the interest part alone. Correct. Discount rate, correct na, discount पर market rate apply करो. This is the present value of liability. Which liabilities are here? There is no principal. Here there is no principal, only liability. I mean interest is what? Your liability exactly. Fine. Total proceeds minus the present value amount. Okay, you collected 1 lakh. Okay, minus out of that, say 9,000 rupees is the present value of liability. That means 91,000 rupees. 91,000 rupees. Isn't it advance for? Isn't it advance for equity, my dear friend? Obviously, it is advance for equity, sir. Obviously, it is advance for equity. That you are supposed to, correct? That you are supposed to transfer it to equity. That's it. Yeah, here this concept is there. It's okay, we don't spend too much time. Let me uh, clear it somehow. Fine, right? Embedded derivatives are there. Are we supposed to separate it? Are we supposed to separate it? Not always, not exactly. Okay, it is based on some 3 questions. Okay, on based on the question, first question, are you measuring the entire instrument at FVTPL? If you say yes sir, I am measuring it at FVTPL, do not split it. No, account it as FL. Full contract will be financial liability. That's it. No sir, it is not FVTPL sir, we are following amortized cost method sir. Oh, is it? Excellent. Then we will ask, is it a derivative on its standalone? Means in the market such kind of derivatives are getting sold? Question mark. Suppose if you want a call option, can I go to share market and purchase call option alone? I don't want Reliance share. Can I purchase call option alone? Yes, yes sir, why can't? Can I enter into future contracts? Yes sir. In the market may on its stand-alone basis, correct? On its stand-alone basis, is it a contract? Is it, I mean, is it available? Available sir. If it right, if you say no, not available, such kind of contracts are only theoretical sir, not available. Not available means what is there to split then? Don't split it. Then next, no sir, yes, such kind of things are available. Right. Is derivative closely related to the host contract? Closely related means what? Host and derivative are one and the same. If it is one and the same, why do you need to bifurcate, my dear? If you say yes, then don't bifurcate. If you say no, it's different, sir. Sir, lease is lease, sir. Reliance company share market value increases separate, sir. That is, there is nothing to do with these 2 things. That means they are not close related. They are different markets. Then you have to split and account it. These 3 conditions are there which you need to keep in mind. Okay, but E level I don't expect in examination. But yes, information, there is lot and lot of information, my dear friend. Correct? Yes. Chalo, anyhow, let's go to the next point. Yeah. FVTPL. What is FVTPL? Fair value through P&L. Okay. Yeah. When do you classify? We'll see broadly FVTPL. Category 1, category 2. I will decide it. Category 1, category 2. Category 1 by its very nature. You are deciding it is by its very nature. Yeah. By its nature. What is by nature? By looking at the quality of the instrument. I mean, what is the purpose and nature of the instrument? I will decide. It is category 1. Right. It is held for trading. Why did you buy the instrument? I just want to buy sell and make profits, sir. Oh, like that. Then yes, it is primary objective to make for buying, selling, and making the profit. Then it is FVTPL, no doubt. Right? Next, it is a part of portfolio of financial assets and liabilities. Okay, sir. I have a portfolio. Portfolio means group of. Yeah, E group may what all there? Yes, E group may financial assets are also there, financial liabilities are also there, sir. Okay, what do you do this group? E portfolio is meant for what? Sir, E portfolio is always meant for my cash needs basically. I can say cash needs. Yeah, in case of generally what will happen, in case of a mutual fund will keep some portfolio for this purpose. These are not for holding for longer time or something. Okay, they got some information. So and so share value may go up. Understood my point? So and so share value may go up. Immediately they will buy that. Immediately what will happen? They will buy that company shares and hold it for some time and immediately sell it off. Okay, that means what? E-portfolio may whatever is there as financial asset and financial liability, this is useful for my, what is that? Short-term capital gain. Short-term capital gain. I want to book a short-term capital gain. That's the reason. That means once you decide this is the portfolio, okay, portfolio is meant for whatever the assets and liabilities sitting in this portfolio is meant for buy sell and make profit. Then entire portfolio may things without looking at, correct, e item, have you sold it earlier, when did you sell, how long you were holding? No, that kind of silly questions we don't ask. The minute I say this portfolio is meant for this purpose, matter is closed, entire portfolio is treated as FVTPL. That's it. Yeah, a derivative is always FVTPL unless until you followed hedge accounting for derivative. Because derivative, if you will, which we will discuss in the next class mostly, I mean after some time, correct na? When I discuss the financial asset ka classification, correct na? Yes, it does not satisfy SPPE test, and with respect to derivative there is no contractual cash flow. When there is no contractual cash flow, and there is no SPPA test, automatically FVTPL only is the result for them. Got it? Next, category 2. Yeah, you are forcefully, this is forceful. This is a forceful classification. Yeah, listen, in case of financial liability only, E option is available. A financial liability, always it is classified as amortized cost. Kya bola? A financial liability is always classified as amortized cost. Agree? Yes, amortized cost. But forcefully you can bring it to FVTPL. It is possible. Yeah, why are you bringing it to FVTPL? This is to avoid mismatch, accounting mismatch. One concept you must have heard. Correct? You must have heard one concept of accounting mismatch. Yes, for the purpose of accounting mismatch, since if I don't classify it as FVTPL, it leads to accounting mismatch. Then forcefully you bring it to FVTPL. Listen, this is for financial liability, it is not for financial asset. Financial asset may is a forceful, it is applicable to equity. FVTPL to FVT OCI forceful will come, not to go to FVTPL fully free. Anytime you can go to FVTPL. Got my point? Right. So because FVTPL for a financial asset, FVTPL is the last resort. Understand? If you do not satisfy anything, it will come to FVTPL only anyhow. That's the reason. This is to avoid the mismatch, correct? And when are you supposed to decide this? Not after 1 year, not at the end of the year. It is at initial recognition. At initial recognition itself, you are supposed to decide it. Correct? Na? It should be decided this is an irrevocable option. Irrevocable option means a financial liability generally is an amortized cost. Right. But forcefully you can bring it to FVTPL. But once you bring it to FVTPL, you cannot go back. You cannot go back to, understand? You cannot go back to amortized cost in the future. That is the matter we are trying to tell you. Fine. Next, FVT OCI, sir. Yeah. When I say FVT OCI, fair value through fair value through OCI, other comprehensive income. See, when I say FET OCI, only fair value changes should be routed through OCI. But on that instrument, if you receive interest amount or dividend income, that should normally be transferred to P&L. Only the gain or loss, fair value fluctuation gain or loss should go. Right. On disposal, FET OCI, correct na? On disposal, FET OCI, that should be transferred to P&L statement. Got it? But if it is FET OCI equity instrument, what will happen? At the disposal, the accumulated gain or loss will be transferred to retained earnings. This is called reclassification. Reclassification we call this, and this is called reclassification adjustment. Routing it to profit and loss is called reclassification adjustment. Understand? Yeah. Within the SO, that reclassification means it is a movement within the SOCIE, statement of changes in equity. One reserve to another reserve shifting. One reserve to another reserve, if it is shifting, then it is reclassification we call. It is not reclassification adjustment. Okay. Amortized cost. Amortized cost means what do you calculate? We will calculate IRR. That's all. Correct na? What do you do? What are your expected cash flows? Yeah, expected cash flows over the life. Right? Yes. You just put it in one format and put a formula called for IRR in Excel. That's all. That will come. That rate only we will be following it. Amortized cost means that is opening balance. Correct na? Plus interest. Yeah, plus payment or receipt, whatever. That is the closing balance. Closing balance, amortized cost balance you can call it as. Yeah, amortized interest, correct. This rate, what is the rate we are applying? IRR rate we will be accounting for. That's all. Next, one more concept. There is transaction costs and etc. are there, my dear. Yeah, there's so many things of, okay, I'll teach transaction cost, I will explain, and in the next session we'll look at the remaining part of it. Transaction cost means what? Which are directly attributable, or another word to say, which are incremental. Yeah, what is incremental? Sir, I have incurred this because of the debenture issued, sir. If I had not issued the debenture, no sir, I would have not incurred this. Yeah, that means debenture issue expenses, transaction costs, brokerage you paid, legal fees you paid, correct na? Whatever professional fees you have paid, any such kind of thing. Fine, all those things are transaction costs. Right? What all transaction costs include? Transaction costs include that's what fees, commission, agent, brokerage, dealer. Okay, transfer, any taxes, any duties or levies, any professional fees. I told you, all these things are part and parcel, but it does not include the discount at the time of issue, premium at the time of redemption, no. Premium on redemption, discount on issue, no. Interest cost, no. Internal administration cost or any holding cost, sorry, these are all not called transaction costs. These are all not called transaction cost. Okay, yeah. So how do we account transaction cost? Let us have a look at it. Okay, in the next session. What's the time now? 11:45. Yes, again at 12:15 we will be back and we'll try to give a conclusion. Right? If I told you, if I'm not able to do it in full-fledged, then I'll take another half an hour, another date. Fine? Right, my dear. Thank you, and see you again at 12:15.